So the centralized ecosystem, you don't have full control of your assets. You don't have full transparency of your assets or performance, what people are doing with your money, real-time P&Ls, etc. You don't have real-time or historical easy access to transaction history to see if a manager has been executing things in a good way, in a best execution kind of style. And because you don't have that transparency, it lends itself well to people taking advantage of the lack of transparency.
Hello and welcome to the Lewis and Kyle Show, an interview podcast where Lewis and I interview top performers in the areas of entrepreneurship, investing, cryptocurrency, really anything that lights us up. Today we have Mona El Issa on the podcast. Lewis, why don't you tell us a little bit about her?
Yeah, so Mona is the co-founder and very involved with the Enzyme protocol, which is an extremely awesome decentralized finance project for on-chain asset management, which she'll do a much better, more thorough job of explaining than I just did in this interview. We talked to Mona about the differences between the crypto decentralized finance universe and the traditional finance universe in layman's terms. So don't be afraid of all the jargon that is going to come in that. She broke it down in very simple terms. We talk about the opportunities in the space for people at the beginning of their career. We talk about some of the fundamental assumptions that are different between traditional finance and decentralized finance, and how those affect things like governance, those affect things like regulation, those affect things like security and interoperability. We also discuss how to properly build incentives in the space to try to construct as much of a win-win universe as possible. It was a really fun conversation. Mona is very smart and has thought a lot about all of the problems that we posed to her, and I'm excited for you to listen to it. So with that, enjoy this conversation with Mona.
Mona, welcome to the Lewis and Kyle Show.
Thanks, great to be here.
Yeah, we're excited to have you. So we know that you've been in the crypto universe for a few years now, and today is actually a big day for it. But I wanted to ask you about where you live, which is Zug, Switzerland, which is sort of coined as the crypto valley or the Silicon Valley for crypto. And what is it like there during a bull run?
So full disclosure, I actually don't live there currently, but I did spend a few years there, and I have lived through a bull market in Zug, and I visit there for work, obviously still quite regularly. And I don't live too far, to be fair. But yeah, it's great. The town is like, or the city is always buzzing. There's always people coming in and out from abroad, from other places in Switzerland. There's kind of nonstop crypto events happening. There's nonstop events organized by local partners, government. Government is like hugely encouraging of crypto projects there. So they do a lot of networking events. They bring government officials. They bring a lot of interesting visitors come through, whether it's like international regulators or the Vitalik Buterins of the world, or the, kind of investors of the world looking to scout for projects. So it's a pretty good place to be in. I would say though that this bull market, obviously we have the COVID circumstances, so probably travel is flowing a little bit less freely than it did like last time around.
Yeah, I'm reading The Infinite Machine right now about Ethereum, and it talks a lot about Zug and Switzerland. So it's interesting that you've been there, because in the book it talks about like the very first meeting they had there in Switzerland, and they were like, well, we could make this the crypto valley, and it's crazy that they actually did it.
Yeah.
But so the next question, just generally, and I try and explain decentralized finance to like people like my mom, and they're like, why are you interested in this? I'm like, well, it's all these different reasons, but if you could just explain in layman's terms, why is decentralized finance better than traditional finance?
So I actually don't like to take a judgment that it's better. I like people to decide what's better for them. I think that's the better way to phrase it. All I would say is that it's different, and it's an alternative financial system. So I would say that a traditional finance it's very centralized. It's often, actually you don't need to look much further than the recent kind of Robin shenanigans with how a centralized entity can ban trading and forbid its users from doing something which is potentially, there was frankly nothing. Not that there was nothing wrong with it, you could debate that, but that kind of stuff happens all the time in with bigger kind of organizations and never gets called out. So why was it called out when, for once the people win, So I think that it was a perfect example of how centralized organization can restrict access from players without substantial evidence or without actually having any real grounds to do that. And so the centralized ecosystem, you don't have full control of your assets. You don't have full transparency of your assets or performance, what people are doing with your money, real-time P&Ls, etc. You don't have real-time or historical easy access to transaction history to see if a manager has been executing things in a good way, in a best execution kind of style. And because you don't have that transparency, it lends itself well to people taking advantage of the lack of transparency. And last but not least, I think another really important point is in traditional finance, you need a lot of financial intermediaries to help establish trust between people, because if you want to trade, you need to make sure that the buyer and the seller settle funds at this, and that the buyer doesn't send, whatever dollars to the seller, but then never gets back whatever he bought. And so you need financial intermediaries and gateways to ensure that the trust in the ecosystem is enforced between market participants and that the financial system can work well. That all obviously adds to the lack of transparency and it adds to the cost. So in decentralized finance, you work with a tokenized economy. So by definition, everything is digital and everything is on a blockchain. And the blockchain lends itself really well to transparency and security. And it also lends itself well to removing the need for financial intermediaries, thanks to decentralized finance protocols, starting from exchanges like Uniswap, Kyber, etc., for trading, because of the instant settlement, because of conditional settlement that you can embed in smart contracts, because you're working with digital assets. You have lending and borrowing protocols like Compound and Aave. Again, these don't need financial intermediaries because the smart contracts embed kind of the job of the financial intermediary there. And then you have protocols like asset management protocols like Enzyme, where investors and managers or product owners, or even just people who want to pool their trading together, don't have to necessarily trust one another, but can actually reduce the trust required between both participants, because the smart contracts forbid certain non-desirable outcomes. So the last and most important actually point, which I missed, is that it's decentralized. No one can shut it down. Everyone can have access. It's permissionless, and you don't need to ask, you don't need to there's no way for you to be blocked from the system. So I think it's too early to say which is better. Obviously, we like to believe that DeFi is better, but I think really what I can say with certainty is that the two systems are completely different, and they open users up to different types of risks and different benefits.
Yeah, thank you for that extremely clear comparison of the two and the main advantages and disadvantages. I think that one thing that people are really tempted to do when something like the internet or the blockchain is a brand new technology is assume that it's the solution for everything, and therefore it's better in every way than the previous way of handling things. And like all things, there's certainly situations where it's better, and somewhere you don't necessarily need a blockchain, or it adds complexity without bringing any benefit. So you mentioned at the end there about Enzyme, which is your company, your startup. Could you tell us about Enzyme, kind of the mission of it, and then as well towards the end, what the 5 to 10 year best case scenario for Enzyme would be?
Yeah, sure. So Enzyme is a protocol. It's not a company. It's a decentralized protocol, which I do not own, but I did co-found. And it's basically a protocol that allows anyone, it serves two types of users, managers and investors. So anyone who wants to manage their own assets, the assets of others, anyone who wants to co-trade, co-invest, DAOs, organizations, individuals, whatever, can easily set up a vault made up of smart contracts, but using a very easy, intuitive user interface, and define certain parameters by which they want the vault to operate, which DeFi protocols they get connectivity. They can define things if they want it to be open to outside investors or to be closed. They can define certain fees, management performance fees. They can define certain rule sets, etc. And they can deploy this vault to the blockchain in a couple of minutes. It's cheap. It costs less than a couple of $100. It's very fast compared to traditional kind of equivalents. And it's obviously very secure because a lot of it's enforced by the smart contracts. Once you've deployed, you have like a one-stop shop to manage all of your DeFi activity from that vault as a manager. You can manage things like reporting, you get your trade history very easily. You can manage things like depositor, like inflows and outflows. You can manage your P&L in real time. You can get risk metrics and reporting metrics like in a real time basis. And so it basically, that might not seem like a big deal, but to fund managers or asset managers or any kind of finance people, this is something that's quite hard to achieve in traditional finance at low cost and high speed. So this is a huge advantage. The other type of user we cater for is like investors or depositors or investors who want to invest together. And basically they have full transparency over all the products that we have on chain. They can browse like track record on chain. They can look for proof of reputation, proof of performance, proof of, anything. Basically, they can get in contact with managers and they can choose to invest. And the upside for that is if you're a small to medium sized investor in Ethereum and DeFi, gas costs are very high. So they get to bundle those transaction costs alongside others. And the other advantage is that they don't, as you guys probably know, DeFi is starting to become very complex and very hard to keep on top of. And so unless you're doing it full time, it's probably very difficult to stay on top of the best opportunities. And it's arguably better to delegate that to someone who is doing it full time.
It is a full-time job to try and keep up with this ecosystem, especially right now. And having the opportunity to be able to, with one button, invest in the people that are doing it full time and have been doing it and have been posting returns consistently above the market is something that, that is why I reached out to you. I think that's the most interesting thing to me, is just that these people are writing their returns in stone. Everyone can see it. There is no question as to whether or not they actually did it. And, in traditional finance, it's like, in order to get to these people that are posting these really good returns, you have to know somebody in order to even talk with them. And then once you get into the conversation with them, it's not like you can see their monthly returns for the last, 5 years, like you could with Enzyme, or I guess like 4 months, because it's
that's the goal.
But you spoke a little bit there about gas fees, and I wanted to ask you about whether or not the Enzyme team is exploring layer 2 scaling solutions, and whether or not it's even applicable for you all. And if you are, what solutions are you optimistic for?
Yeah, so we're definitely looking at layer 2 solutions. I think everyone is. We're, in close contact with a lot of the teams doing cool stuff there. We're still a little bit on the fence in terms of going all in on any particular solution because we think it's just too early. But we're fascinated by some of the stuff happening. And we think probably shorter term, nearer term, more likely thing would be to take some of the bigger and more liquid products onto layer 2. So like the vault tokens themselves, and then create liquidity for them on a layer 2. But as a first step before thinking about moving an entire protocol into a layer 2 solution. And the reason for that, by the way, it's that there has to be, we are an asset management protocol, so you have to have a wide range of assets to manage. So the idea of moving to some other kind of fully fleshed out solution before there are substantial assets there just doesn't seem very smart in our mind.
That makes sense. And I definitely want to ask you about, as we move into the future, do you think that all assets will become digitized over a long enough time horizon?
Yeah, totally. That's why I got into, that was the assumption that I based 5 years ago when I got into this space. I was like, everything is going to be digitized eventually or have a digital share class. And so based on that assumption, we can improve asset management, or at least automate asset management in a way that I obviously personally believe is better and more efficient for the smaller guy, but remains to be proven.
I tend to agree with you, but I think that my reasoning is probably far less nuanced than yours, because you've been thinking about it for so long, and your background at Goldman Sachs and all these things. So why do you believe that assets will be digitized in the future?
How do you justify that as a base assumption?
Okay, yeah. So I guess like, why wouldn't they be? Like, it's so much more efficient, it's so much more transparent, bookkeeping, reconciliation, settlement issues are the cause for really big errors, failures, points of failures in hedge funds and banks, you know, those kind of booking errors, etc., or lacks of transparency. Like if you look at like some of the big rogue traders that have, you know, been responsible for losing billions because they started betting too big, you know, one of the problems was that their risk managers and bosses didn't have the transparency to read through into that. The other reason is just a lack of efficiency. Like, you know, traditional assets, like, you know, equities, they settle still T+3 or T+2, depending on which country you're in. That's 3 days to settle an equity or to settle sometimes an FX transaction abroad. Like that is just not efficient. People need, you know, higher efficiencies. It's expensive. Again, you don't see where the fees go. You have no transparency. So, you know, basically there isn't much downside, and there isn't any downside I can think of. And all the upsides are higher efficiency, higher transparency, lower risk profile, lower risk of something going wrong, making people's lives easier. And so I guess the only downside is that, like, you know, people make a living for being the intermediaries that help settle trades. And so they're going to be out of business. That's one negative, I guess, for them. But yeah, my assumption is just like, you know, every single sector in the world has been disrupted by finance in the last 50 years, except for finance. So why not finance?
I love that. I agree with you. Can you briefly explain tokenomics to us and like how these different protocols, you know, Enzyme specifically, how are you managing to extract as much value from your protocol as you're creating in the form of this token? And how do you make decisions to make sure that that stays?
Yeah, so tokenomics is fascinating. So let's just focus on enzyme tokenomics for now because it's easier. So I think tokenomics is fascinating because it allows you to benefit from network effects. And what do I mean by that? You can align different stakeholders in your ecosystem to perform in ways you want to perform if you design the right tokenomics. So what does that mean? So if you take the enzyme ecosystem as an example, we have three main stakeholders. We have the developers who contribute to the open source code and the maintenance, etc., and future development. We have users who you can think of as like managers and investors into the vaults. And then we have the token holders. So there's three kind of user groups, stakeholder groups. Now, we want to create a mini economy for asset management with the MLN token, which powers Enzyme. So how do we do that? And how do we make our little mini economy work in a way that's beneficial, mutually beneficial to everyone? So what we've designed is the MLN token is a utility token. So users who use the protocol pay for it, and ultimately that gets captured in Melon tokens, and then those Melon tokens get burned. So they get removed from the supply. And this is really important because it ties into the second and third user group. Like when they're removed from the supply, as you know, like basic demand supply, less supply equals higher price, or it results in a higher value most of the time. And so you're removing them from the system. So you're basically making a direct link between usage on the network and the value of the MLN utility token. And that means that if you're a token holder, you're incentivized to help grow the users on the network, because more users equals higher value for you. So essentially you can like, it's almost like employing an entire team of thousands of people to work for the protocol, you know, in terms of marketing, biz dev, etc., because they're incentivized to do so. Not that they all do, obviously, but in a perfect world they would. And then the third stakeholder group is the developers, and the developers are thinking, hey, my code directly brings, you know, if my code base is good, if my application is good, I'm bringing more users to the network. And so again, the MLN token price goes up as a result, and developers in the ecosystem earn an MLN token because there's a disinflationary system where we can mint certain number of tokens every year in order to pay contributors on the protocol level. And so the tokenomics design is designed such that all these three stakeholders are like perfectly working together in sync and aligned to make each other successful.
Thank you for explaining that. So if I understand correctly, and if I'm a believer in Enzyme, and I think it's going to be, you know, the future of on-chain asset management, the best way for me to participate in the upside is to buy the token. Obviously not financial advice, but is that how I would, as someone who believes in you and the protocol, participate in the potential upside?
Yeah, exactly. Yeah. So if you believe that the usage or the assets under management would increase on the Enzyme protocol, the best way to express that view would be to own MLN.
I have a question about the tokenomics. Would this lead to a potential like similar gas price scenario because it's tied to use on the network, where like if it becomes too valuable or something that people like won't want to burn tokens? Is that like a possibility?
That's a really good question. The way we had designed it originally, yes, because if you fix the price in MLN tokens and the price of MLN, appreciates versus other currencies, then yes, you would end up paying crazy amounts in fees. But we actually denominate the fees in a stable coin now. They're still sort of ultimately collected and converted into MLN. But in order to stabilize that effect, we actually charge them in a stable coin, or we set them in a stable coin.
Yeah, there's so many interesting rabbit holes we could go down with that. But to touch on what you were saying about the stakeholders of Enzyme and how you sort of have aligned these three different groups to work toward the betterment of this protocol. I wrote something the other day about like how DAOs and these decentralized protocols are like sort of solving the principal agent problem, because there's less agency in these protocols than there is in other sorts of governance and collections of people. Do you agree with that? That over time, because you can align incentives in this way, the principal agent problem is reduced?
Yeah, I do. I have to say though that I think one problem that is not aired enough in DeFi is that decentralization is obviously good for all the reasons we stated, but it does have trade-offs. So the more decentralized you become, by definition, the less efficient you become. So let me give you an example. So the far centralized end of the spectrum is the most efficient because one person needs to make a decision and then things can move forward. The medium kind of decentralization, or the decentralization where you have, let's say, a board or a committee of 10, 11 people, which in my view is still very decentralized because it's very unlikely you would have 11 corrupt people on a decentralized board like that. You still have the decentralization, but you still have some degree of efficiency. But imagine now you had 1,000 people, and in order to, 1,000 different people in a governance ecosystem, and each person had one vote, and you needed 50% quorum to pass a vote, you would need to wait for 500 votes to pass every time you needed to make a decision, which can become highly inefficient because, frankly, even if they're incentivized, like we've learned over the last few years that most voters are passive unless they're highly incentivized.
So could you solve that by just like putting a time limit on the vote and the total amount of votes
There's many different ways that people have experimented with. I mean, then you could say, but if the time limit is over and only 10% of people have voted, which I've seen happen before, is that really decentralized then?
Right.
Because it could one token holder alone could own 10%, for example. So, I guess depends. If it was one vote per person, then that's fine. But if it's one vote for each token, that's kind of quite easily gameable because you get, some of these large crypto funds can just buy up 5-10% in a second with the amount of capital they have.
Yeah, it's really interesting the incentives here and how it'll play out in the future. I think governance is, as most people say, just not solved yet, and whoever can really do well with governance is setting up themselves to be written down in the history books, because I think that's a really important problem. But switching gears here pretty harshly, have you been in contact with US regulators about the Enzyme protocol and like on-chain asset management?
Or does that even matter?
Yeah, or does it even matter?
I have not. I've been in touch with US lawyers, and I've been in touch, we were actually mentioned in the SEC
I saw that
research report on DeFi, so they're clearly aware of us, I would imagine, and projects similar to ours. We have no US presence at the moment, like from a company perspective, and obviously we haven't been able to travel there for a long time. But we follow we follow kind of the progress. Like, there are some really big forward thinkers there from Hester, like Hester Pierce, etc. And I think like from our perspective, what we don't have to, what we sort of generally lobby for as much as possible, as I said earlier, I think it's way too early to know whether DeFi is a good thing or a bad thing. I think one thing we know for sure is, or one thing I know for sure is it would be highly stupid to put DeFi in the same bucket as TradFi in terms of a regulatory perspective, or hold it to the same standards, because it would instantaneously overnight hamper innovation and kill the entire industry. So the other thing is, like, there are some, there, like I would say almost all of the regulations which were designed with a different baseline set of assumptions for traditional finance, we assume that those rules were generally created to protect consumers and to protect the retail investors, etc. Many of those risks disappear with DeFi, provably. And it's true that you have a new set of risks that occur because of different and new assumptions, like, the fact that the whole system is built on a blockchain, for example. But they need to be, if ever, regulated with that new set of assumptions taken into consideration. So we're, of course, like, we're very active, especially with the association that I'm a member of, Multi-Chain Asset Managers Association. We're very active in terms of providing our feedback to consultations from different regulators and governments all over the world. But generally speaking, our position is don't regulate DeFi now. Just stand back, watch, let it evolve. Let's figure out which components are good, which components are backed with trackable data, and then let's address those problems as and when we see fit. Because anything else would just kind of stunt everything right now, I think.
Definitely. Could you tell us a little bit more about Mama and like what that organization exists to do?
Yeah, Mama was an organization I co-founded in 2017. It's a global association designed to represent the interests of decentralized finance products and projects in on-chain asset management. The idea is a lot of us are voluntary. We have over 60 members, a lot of the well-known names in the DeFi space, but also some traditional asset management players as well. And basically the idea there is that we when a regulator asks for an opinion on how should, for example, let's keep it very general, DeFi be regulated, we don't want, the JP Morgans of the world being the only ones to respond to that. We want to be able to, in a unified voice, represent DeFi and make sure that our interest is being represented on the table as well. And so that's basically that was the founding premise of Mama. And that's what we've always aimed to do. We also, in line with that philosophy, we're also very focused on education, trying to educate regulators and governments, etc., on the benefits of decentralized finance and the differences between decentralized finance and TradFi. And that's kind of in a nutshell, basically.
Sounds like a good voice for decentralized finance. I have a question for you. I think that I might be completely wrong, but I wanted to hear from you what you think about. Are there systemic risks in interoperability and composability of these protocols built on top of Ethereum? Meaning, like, if one domino fell with a smart contract and something like Maker, could that spread widely across? Could it spread widely across the decentralized finance ecosystem in sort of a domino effect way?
It definitely could, because we're at a stage where DeFi is highly composable. But it's also mitigated by the fact that we have insurance players like Unslashed and others working to ensure DeFi protocols and groups of insurance protocols together to help protect against those kind of risks. So you're totally right. Of course, there's a systemic risk. It's a different kind of systemic risk. I would say occurs because of two main things. One is poor financial design. So unfortunately, a lot of the protocols that are emerging in DeFi are just poorly designed because they're built by people who don't maybe really understand finance, but do really understand tech, but don't really understand finance. And so, in my last few years, I've seen some things which have horrified me in terms of design perspective, and which I've thought to myself, wow, that almost shouldn't be allowed, So that's one thing that can cause a systemic risk. And the other, kind of poor financial design and not thinking things through, and people not fully understanding what they're getting into it, and then being a victim of that poor design. The other thing that I think is a systemic risk potentially is like unintended consequences, like so vulnerability in a code or an attack vector that wasn't actually intended or planned, but someone found a way around it. And we've seen that with a lot of the DeFi hacks last year. I don't think we've ever seen anything systemic yet, but I'm sure we will in the coming years. And so I don't necessarily, again, going back to the regulatory topic, I don't think that means that DeFi has to be regulated, but it's just something to emphasize that anyone getting into the space should really do their homework. It's a world, like we talked about at the beginning, these two alternative financial systems. In the traditional finance system, it's almost like the regulator takes responsibility for your actions. They try to protect you against what's not good for you. They try to prevent you from making risky investments. I personally am not a fan of that. I think everyone should have freedom of choice, etc. But that's the way it is in TradFi. In decentralized finance, it's the Wild West. It's the opposite, extreme opposite of that. Anyone can access anything. No one has to have any qualifications. That's all great, but it also means that you are responsible for your actions. There is no one to blame if it goes wrong. There's no one to protect you if it goes wrong, unless you were smart enough to buy insurance. And there's no one to like pay you back or make you whole. So, you know, again, it like sings to these kind of two different systems. They both have their benefits. They both have their, you know, negative points, and people have to decide what's best for them. And personally, I would think that a rational person would have some exposure to both financial systems and just allocate to those two different systems as he or she thinks is sensible for their own risk profile.
So I have a career-based question. A lot of our listeners are young people, kind of early stages. They're in college, they're about to graduate, or they're still so early in their lives. You had traditional finance at the beginning of your career and have now transitioned in the past couple to DeFi. But for someone just starting out their career, what would you identify as some of the unique opportunities present within DeFi someone interested in the space and excited to be a part of the Wild West should consider, whether that's being like a Solidity developer or joining a protocol in some other way? Like, what are some ways young people can join the space and make it like a legitimate contribution?
Well, there's loads of jobs going right now, especially for developers, but frankly, across the whole spectrum. I think Solidity developers, good Solidity developers are in high demand. So, you know, we're hiring in that space. Good developers in general, you know, good data scientists are in high demand. I think personally, if I was a student graduating now, I would be, and I was interested in this space, I would be immersing myself into all the, you know, kind of chat forums, etc., and learning and using protocols and trying to get familiar with them, and, you know, inserting yourself into communities and figuring out what you like and what you don't like. But, you know, there's opportunities from biz dev, growth hacking, growth engineering, social media jobs, organizational posts, marketing. I think that, yeah, I mean, we're obviously the industry, the sector is in a really good space right now. And if you are looking for a job, I would encourage you to get your hands dirty, try different protocols, ask questions, get to know the people in the chat, see which kind of communities you respect, you look up to, which ones you find less, you know, less interesting. And I probably would try to align yourself with people who have some form of track record. I mean, you can always go with like someone who's just like appeared out of nowhere and doesn't have a track record, and there might be more upside for you in that, but it's also much more risky. And I think that important that I've learned in my career is I always feel like I want to be challenged, and I always feel like I want to be learning. And so if you are in a chat asking questions and you feel like you're not learning much from the answers, you know, I would push yourself to be challenged, because that's how you'll grow and that's how you'll make a great career for yourself.
Thank you.
Yeah, I love that answer.
It's a lot of opportunity. I think we'll transition now to bonus round, which is just some faster questions, kind of all on the same topics, but not in any sequential order. So one thing I noticed when doing research for Enzyme and learning about you for this podcast is that Enzyme is rapidly approaching an AUM of your previous fund size. What does it feel like to potentially in the next couple soon, I'm not totally sure, don't want to put projections here, cross over Enzyme exceeding the previous fund you're managing in terms of assets under management?
Yeah, pretty big actually, like feels great. I mean, yeah, you're referring to before I even got into crypto, I ran a fund which was around 30 million at its peak. And we're about to cross that threshold, I think, any day now on Enzyme. And one thing that has struck me is the first time round in TradFi, I managed to raise the 30 million in like 2 or 3 months. With Enzyme, it's taken us 5 years as a team collectively to get there. So it's been a long journey till we got here. So it feels well deserved, to be honest. Like it feels like good, like in that feeling like when you've run a marathon and you feel like you deserve that pint of beer afterwards or whatever. But I think that it's just the beginning. The big vision is really, I think you asked me at the beginning and I skipped through the question. I forgot to answer it. But what's the best case scenario for Enzyme 5 to 10 years from now? And for me, it's really to be the infrastructure that underpins everything in decentralized asset management. So that's, a multi-trillion-dollar opportunity. I think it's huge. I think it's not impossible. We're the only decentralized asset management protocol that has been around continuously and consistently with one unique, kind of consistent vision for the last 5 years. I always like to joke, in 2017, we had 15 competitors or so. Then it went down to like 2 in the bear market, or 1 even. And then like now we have 15 again in the bull market, and kind of like the one constant has been us like throughout the whole process. So I feel like we stand a good chance of surviving good and bad because we've done it once before.
Absolutely. And I kind of have a question along the same lines. I know you started, I guess, 5 years ago. So that was 2015, 2014. And I was having a conversation with somebody yesterday about how, they're really into crypto, and they're like, I felt stupid. Like everybody that knew anything looked at me like I was stupid 5 years ago. And so, when you left your job at Goldman Sachs and you're telling all these people what you were doing, I assume that you got some, negative feedback. And to have the total value locked in the area that you're looking at or that you're investing your time in go from, I assume, under $30 million to over $57 billion in the time that you've been involved in it. Do you feel extremely validated?
Yeah. Yeah, I'm not gonna lie. Yeah, I do actually. And I mean, I can't tell you the number of times investors told me over the last 5 years, you're too early, this isn't gonna happen, it's like at least a decade away, etc. So yeah, the fact that it's happened, I mean, these conversations were less than 2 years ago in many cases. The fact that it's happening now, yeah, I basically just makes me want to call them all back and say, I told you so, ha 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 ha. So yeah, totally. And for my old traditional finance colleagues, like I think, by the way, those doubters were also in crypto too. Like it wasn't just traditional finance, but I think for the traditional finance people, I think the truth is it's so intense when you work in traditional finance. Like there's so much going on, and it's such an intense, if you work on a trading floor or whatever, it's so intense. You just don't have the band. I mean, DeFi is hard to understand. You need time to invest, and by the time it gets to the weekend, those guys are all like beat if they even get a weekend, and they're like sort of, So I don't blame them, because I think if I was still in traditional finance, I wouldn't have the bandwidth to look into it. But I do, I do remember, I think that generally speaking, a principle of investing, a principle in life is if everyone tells you not to do it and you're convinced that this is something you should do, and you have like good evidence or a really strong view that is supported by various assumptions or, whatever, then trust your gut feeling and go for it, because often those are the best trades in life, the ones where they're sort of super anti-consensus, and the ones where if you're about to buy Bitcoin at $62,000 and all your friends are telling you you should buy, that's probably not the right time to buy. You want to be buying when like everyone's telling you not to buy or to sell.
I love that. It's very difficult to make those contrarian decisions, and this seems like one that has been playing out pretty well. So I have another question about how users are using Enzyme from an investment perspective. I was looking at the breakdown, and again, this is fascinating to me that it's also transparent and I can just go through and see exactly, and anyone can, how the $28 million on Enzyme, like what that's composed of. Does anything surprise you about how it's broken down? So I looked out of the 28 million, there's about 5 million in wrapped Bitcoin, 5 million in wrapped Ethereum, and then kind of a long tail of other popular projects. Is that like a distribution you kind of were expecting? Were you expecting a greater amount of speculative plays, or Like, is the way it's being used by active investors at all interesting, or anything worth
I think
commenting on
it makes
there?
sense. I think it makes sense. I mean, I would be surprised if it was all going into more speculative stuff, because that stuff is also less liquid. So if you're a good fund manager or, vault manager, you want to make sure that you're able to provide liquidity, you're able to get in and out of positions easily if your market view changes, and really only Bitcoin and ETH and some, are the ways to do that. So I think every portfolio obviously depends on your strategy, but most portfolios should, to be prudent, have some allocation to Bitcoin and ETH. So yeah, that's kind of my view on it. It hasn't really surprised me. I think what's been exciting really is having a lot of the new and recent integrations we've been doing with lending protocols like Aave and Compound. We have farming now possible, where you can farm and claim rewards for lending, or we have the ability to deposit into AMM pools and earn, rewards for that. And we're going to be integrating borrowing soon, things like curve pools. We have Alpha Homora. So you can see the whole, the whole space kind of coming together in one place from an Enzyme vault quite quickly. And I think that will be interesting to observe in the next 3 to 4 months, like how manager activity changes when we have all those additional kind of integrations possible.
I have another question. So I think that Enzyme is going to catch fire at some point, in the same way that, this DeFi pulse graph looks, and it'll go from, 30 million to a billion a lot faster than from 0 to 30 million, like in total assets in these vaults. What do you think the opportunities are for, a front running fund manager as someone that's getting their returns written in stone? And do you think that it should be a concern where, someone has been playing on Enzyme for years, or a year, I guess, and they posted good returns consistently, and now they've got this opportunity to raise capital at a non-linear pace? Do you think that could potentially change incentives for these fund managers, or change the way they act?
So you're kind of asking if winner take all effects could be too strong.
Right.
Yeah, I haven't really thought about that too much. Yeah, it's possible. I think we'll just have to wait and see how it plays out. I think solving for a problem before we actually have it is probably not a good way to spend our time. Our philosophy, generally speaking, is let's worry. We try to build the infrastructure as best we can. We try to foresee as many of these kind of well-known and well-documented problems we have learned from experience in traditional finance, and also from DeFi mistakes we've seen other people make. But other than that, we're kind of in the camp of let's not over-engineer solutions for things until they become a problem, because it comes at the expense of technical debt and time that could be spent on on more useful features, for example.
Yeah, I really respect that answer, for sure.
I have a train coming behind me, so I'm like, I live very close to train tracks, so that was very loud for a moment. I think it's good though. So a question I have, we've all said this a couple times on this podcast, is that keeping up with the space is a full-time job. So
Yeah.
Who are some credible follows, credible thought leaders, credible publications that maybe send, those reports that are actually worth reading to stay in the space, or stay abreast on the space?
I love reading Camilla Russo's Defiant newsletter. I love her podcast. I'm a big fan of Delphi Digital Research. I'm a big fan of Masari Research and Alerts, etc. I think those would be my favorites, to be honest.
Amazing. A couple quick questions. How do you feel about the intersection of real estate and decentralized finance? And as you've said, you believe, and I believe, that all assets will be digitized in the future. Can you put a timeline on real estate, in your opinion? Yeah,
real estate's already digitized in many places, actually. Like there's Realty that are doing a great job. And I've heard of some other projects, I forget their names now. The issue there is, by nature, those assets are not as liquid. And so pricing them on chain, is still challenging. I think Realty have come up with some cool ways to approach that by creating liquidity pools on Uniswap, etc. But it's going to happen. It's just a matter of, solving the kinks that exist today in terms of, what's preventing it from taking off. But I kind of feel that it's a bit more challenging for securities in general and traditional finance-backed assets, because they're subject to a little bit more regulatory gray area uncertainty at the moment. And I think once there's a bit of clarity on the reg side there, then they can probably accelerate much faster.
Do you have any questions for Realty? Because I'm meeting with Remy today, actually.
Oh, you are? Yeah, I haven't spoken to them in a while. Yeah, I'd love to know how they're tackling that liquidity issue and how they're going to scale. I think it's like an awesome idea, and I'd love to bring real estate tokens into Enzyme in the future.
That's the future I'm excited for.
There you go. Facilitate the connection.
A good place to end. Maybe one last question. Well, if you had one piece of parting advice for somebody who's 21, just entering the workforce, graduating college, doesn't have to be about finance, doesn't have to be about decentralized finance, what would it be?
I think my piece of advice would be if you want to be successful in your career, go for a career that you can be passionate about. Go for a job that you can be passionate about, because like don't get fixated on where the money is or what's hot, but what are you really passionate about? What do you enjoy? What can you get excited about? Because I feel like if work is fun for you, if work is like enjoyable for you, you'll excel at whatever you do, even if it's not immediately obvious how.
Well, that's awesome. Where should people go to learn more about Enzyme and or keep up with you?
So Enzyme, you can just go to our website, enzyme.finance, and you can, access all of our social media links from there, keep in touch with our news. And for me, you can probably best places to follow me on Twitter. I'm at Mona_LEL_ISA. And yeah, I'd love to hear from you guys and stay in touch. And yeah, if for anyone who is like pursuing a career in this space, like wishing you guys all the best of luck.
Well, thank you so much.
Thank you. And that wraps up our conversation with Mona El Issa. I thought it was really, really cool. 3 of my takeaways quickly are, the first of which is work on what matters. I asked her like right before we started the call about the Coinbase IPO and what that meant, and then I asked her really late in the podcast about a sort of winner take all question, and she's like, we don't really think about that. Like we're heads down, we're building, and I just think that that's really cool that she's able to focus on what actually matters, and that's what she's actively doing. The second is, it was really cool to see her light up when I asked her about the validation that she feels having worked in DeFi for, I guess, 5 years now, and how the space went from a $20 million tiny industry to now the talk of the town. It's got $55 billion wrapped up in it, and for her to have been there from the beginning, I think it's got to be extremely validating, and it obviously is by the way that she smiled when we asked her that question. And then the last one is just her ability to be transparent. She's building Enzyme, and one of the big benefits of Enzyme is the transparency that it provides for both investors and these fund managers. And it's obvious that she cares about that, because she even is being transparent about the realities of decentralized finance and traditional finance. She's like, it's not obvious yet whether or not decentralized finance is a good thing. And for her to be able to say that after going through this gigantic growth is super telling of how good she is at critical thinking, and how she's willing to evaluate the facts instead of being, just riding the hype. But those are my takeaways. What do you think, Lewis?
Yeah, 3 different ones, which is good. We do a lot of repeating each other here, so it's good to not do that. First takeaway is joining communities as a way to get involved. Most people, this is something we said a lot earlier in the podcast, not this episode, but like earlier episodes, is you just don't realize how accessible most people are. There's, for almost every one of these decentralized finance projects, there's a Telegram group, there's a Signal group, there's a Discord, there's a Slack that you can just like join. You don't even have to like buy any of the tokens of that protocol. You can just like press join. They make you like fill out like one document, not even document, just like, I accept the rules, I'm not going to harass anyone. And you can literally chat with the people building any of these products and ask them questions. And that's a fantastic way to get involved, meet other people, and learn in like a fundamental level and get like a gut check as like if the humans building this are good people or not. So that's a super awesome way to get involved in the industry. Second takeaway is to not discard everything from the old world. I think Mona has a huge advantage in this space because of her years at Goldman Sachs, and she's seen similar problems before. Just because decentralized finance changes a lot of aspects of finance, that doesn't mean that like certain repeatable patterns and certain incentive schemes won't rise up. And having actually thought about these things and actually seen how things used to be, she has a greater respect for how to design them more intelligently than someone who's coming in this with no traditional finance background. So it's kind of like, don't discard everything about the old world that may or may not be useful. And that's actually potentially an advantage. Third thing is just massive opportunities. I was like, what are some opportunities? She's like, well, there's jobs in blah, 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 like every aspect. She's like, if you want to do social media, there's social media. If you want to do dev, there is a ton of dev. If you needed, like, it's just a growing industry that needs people to help it grow. So if you're interested in this universe, consider it. That's all I have to say about this episode. I agree, Kyle. She was awesome. This was awesome. I hope you all agree with us that it was awesome. I appreciate you being here, listening to the podcast this far. If you want to support us, the best way for you to do that is to give us a rating or review on Apple iTunes. If you want to have a conversation with us, we're pretty active on Twitter. You can jump in there, ask us questions, keep the conversation going about topics from this or any other episode. We have a couple great recent episodes we published in the past few weeks about similar topics, creating confidence with Heather Monahan, a very different perspective on the cryptocurrency DeFi universe with Andy from DeFi Slate, a much more young, unreserved perspective, but still very fun and exciting from the perspective of a 21-year-old in the space. And before that, learning about productivity and existentialism with Kay He. Otherwise, make sure you're subscribed to know when we release new episodes, which will be in a week on Tuesday. See you there. Thanks for listening. Have a good one.